Hi, everyone, and welcome to this week's episode of Money with Alpha. Today, I'm joined by Dylon Mackriel. Welcome.
Thank you. Thank you also for having me.
Thank you. And Dylan is a financial planner. So I wanted or I met Dylan recently. I wanted to bring him on to talk a little bit about financial planning, what it does, and all of the sort of the intricacies of it, because it's an evolving profession. There's been lots of changes that have happened in this space in Australia in the last few years. And I'm also interested to find out a bit more about your money stories and history as well. So before we launch into all of that, just yeah, please introduce yourself and a little bit
Yep.
about your backstory and how you came to be doing what you're doing and why you love it so much.
Yes. Thank you so much. My name. I'm originally from South Africa. I came to Australia in 2013 as an accountant. So I was practicing there for about 5 years as an accountant. I moved over to Australia and found it really tough to enter into the job market as an accountant from South Africa. So I needed to learn sort of the new tax laws within Australia. And so I wasn't getting enough sort of work in that space, but enough to keep me going. I then decided a year later that look, it's not sustainable from a cash flow perspective. I'm getting jobs here and there from a contracting perspective. And that's when I decided to use some of my sort of personal skills, interpersonal skills. Like I like talking to people, and I'm also really good with the numbers side of things. So I thought I'd use my accounting background with my love to help people through financial planning, or at least coaching and educating people, like something like what you're doing, similar to what you're doing with your clients, Alpha. I want to do really and truly coach the public and to help them get ahead of the pack. And so financial planning was started in 2016 or 14, 15 as a junior, just on the phone, setting up appointments
Mhm.
and before sort of moving up the ranks and meeting with clients. So I really enjoyed the fact that I could be a part of the chain that helps someone to achieve their financial goals
Yeah.
until I became a financial advisor in 2016.
Mhm.
So I've been a financial advisor ever since then, and I haven't looked back. I really enjoy working with money or the number side of things, but more importantly, it's the interpersonal skills, the seeing the joy on someone's face when you help them to achieve their financial goals as well, whether that is to purchase another property in there to build wealth or just to save an extra $100 each month. Those sort of things is what I appreciate from the industry itself.
Yeah. No, and I love because the name of your business, I remember when I first saw it, DreamWise, I was like, oh, I like this. It's
Yeah,
you
yeah.
know, most things are just very like pragmatic, whereas ultimately as humans, we talk in stories and we love dreaming. Especially, I mean, as children, we tend to do less of it as we grow up. But I think it's important to recognize that we need to have dreams, and then the money is there to support achieving those or realizing them.
Yeah, yeah, yeah. I guess it's in the name itself.
Yeah.
Dream wise, if you're all going to have those dreams, and why not let's help you, structure it and actually meet those dreams and with some wisdom, I guess. And that's why
Yes.
the owl's there as well for some wisdom
Yes.
um, out of the representation of that.
Yeah.
Yeah.
Yeah, no, it's great. It's very symbolic as well as literal too, so it's great. So I have a question because I get from people quite a lot, like, oh, financial planning, they always need me to have like a minimum of $100,000 or, it's a very regulated industry. It's confusing, it's expensive, da da da. How do you see it and how do you kind of
Mhm.
explain to people what the benefit of it is and the costs necessarily? You don't have to go into specifics, but in
Yeah, yeah, yeah.
terms of when does it become worthwhile for someone to actually go down the path of getting a financial planner?
Yeah, so look, you need a financial advisor sort of from the get-go. Once you start earning money, right? Once you're starting, you need to be thinking about how you can save better, with the little that you have, if you're a student coming into breaking into the industry, into the market, you should have some or speak to at least some money managers in the industry to at least understand your cash flow, right? It all starts with the cash flow. You need to understand your inflows, your outflows to recognize some surpluses that you can potentially use to put away for a rainy day. How to invest that money is where financial advisors then comes in. Now, when it comes to ideologies about, you need $100,000 in your super or in cash to invest and make it and to justify, look, I'm of the opinion that you just need to be working, have superannuation that you can invest and it makes sense to invest and using a professional like a financial advisor because at the moment, government has said that we allowed as financial advisors to charge for financial advising recommendations that will target your superannuation fund at least. So that's something that you wouldn't need to sort of fork out of your back pocket from a cost perspective.
Mhm.
So people think that yes, financial advising is quite expensive. Yes, there are clients who pay out of pocket,
Mhm.
but that's because they want sort of more complex strategies that involve money itself, things like investing outside of superannuation space. And yes, we will be charging them outside of super, but anything that's related to a superannuation fund, like insurance benefits, for example. So we'll look at your insurances, personal insurance like life, TPD, income protection, trauma is held out of super. So that will be outside. But anything that's related to superannuation and which is also related to retirement, we can charge the super fund for our financial advising cost,
Mhm.
just to make it a little bit more palatable for the general public. When that is when that time is when you are not happy with your current structure,
Mhm.
whether that is the cost involved inside of your existing platforms, whether it is return on investments that you're not happy with, or whether it is in insurance benefits for people who are looking into the market and purchasing their first home. Normally their finance brokers would be asking them, do they have personal insurance in place? That then, how can I say, pushes the client to check their insurance benefits inside of their super.
Yeah.
And lo and behold, we've got standard policies that is not really tailored to the client specifications as a working doctor, for example, or a plumber. It's not sort of
Yeah.
it's more general insurance,
Yeah.
and so that brings about another reason to speak to a financial advisor
Mhm.
about those sort of topics to make sure that it's tailored, good quality products for the money that you are already paying through the superannuation fund.
Yeah.
Hopefully that answers that question. Sorry.
Yes, no, that was a comprehensive answer. Thank you.
Yeah,
Yeah.
yeah. Sorry.
So, and I think because we often, especially the younger we are, the less we kind of think about our retirement and superannuation. But as you start to get into your sort of 40s and especially 50s, you're like, oh my gosh, retirement, I can see it, it's looming. I need to get my, act together.
Hmm.
And I think it's a really good opportunity to look at how you can optimize it. I
Yeah.
mean, there's a lot of industry funds out there, but there's still things you can do within that.
Hmm.
And you touch on the insurances, which is extremely important because there's so many nuances in the insurance space and there's so many out clauses that are built into a lot of those policies that you really need someone like a financial advisor who knows the ins and outs to actually be able to tell you, okay, well, I mean, obviously life insurance is pretty black and white,
Hmm.
they used to call it death insurance, but I think that just sounded too dramatic. So now it's life
Too
insurance.
dramatic.
And then your TPD, so your total and permanent disability. Like I've actually had some family members and I've had some clients recently who've been in that space where they've had to actually draw on that, and it can be quite difficult to navigate, especially if it hasn't been set up well. So you need the
Mhm,
specialist to help you set it up, and then the back end you need sort of the lawyers to help you or whomever to help you tap into that potentially as well. But the
mhm.
advisor is there to support you through that. So I think they're
Yep.
both really important. I often get the question around self-managed super funds. Um,
Yes.
what's your how do you see them? Do you like them, dislike them, indifferent? And how do you work in that space?
Yeah, so I actually look, I can't be either like it or not. It all depends on the client itself.
Yeah.
So I'm
Hmm.
driven by what my client needs at the time and where their goals are located.
Yeah.
It's also preferential investment. So my clients might say they would like to invest in property,
Hmm.
and they've now exhausted their capacity to borrow more money to purchase another property outside of superannuation space,
Hmm.
which leads to only one area potentially, and that is to utilize your superannuation funds to then go out and potentially purchase a property or purchase or invest in markets that your industry superannuation fund potentially cannot. That's the main purpose for self-managed super funds, is to take control of your superannuation fund and how to best invest it and in your preferences, right? So
Yeah.
for us, I can I like it because we can have more control, and I also don't like it because it can cost quite a bit for
Hmm.
the clients who are not on a really good or really sound balance collectively. So when we write up self-managed super fund advice, we want to have at least a minimum of $500,000
Hmm.
combined, husband and wife, or there's a collection of up to six members or trustees that can come together to create a self-managed super fund. In
Hmm.
most cases that I've seen, it's normally partners that will enter husband and wife, for example.
Yeah.
So the for myself and for my licensee, it's the $500,000 mark that we would
Yeah.
look to, and then that would justify the large setup costs involved
Yeah.
to then proceed with that sort of strategy. On top of that, it's also the responsibilities of the trustees. Now, the individual members that will never thought about, the accounting behind the super funds that they currently have, or the auditing,
Hmm.
or the insurance deductions, paying the tax on the earnings that they are making. So
Yeah.
there's a lot more that goes into it. And if your clients cannot accept the responsibilities, now we're not asking the clients to deal with everything. There's a group of professionals who come together to make sure that we're managing the self-managed super fund on their behalf and making sure it's compliant.
Yeah.
So we take the stress away from the client himself with the help of other professionals like accountants, lawyers, and
Yeah.
auditors, to make the strategy work. The good side of it is that it's flat fees. There's no percentage-based fees on it. Depends on how you invest it, so it
Yeah.
can be more cost effective over time as you
Hmm.
invest, as opposed to an industry related super fund, which is more percentage-based fees, right? So
Yeah.
it can go quite high versus self-managed super fund costs in total, which can be flat for a longer periods of time.
Yeah.
So from my perspective, a self-managed super fund can grow wealth exponentially for clients who are looking to tap into the market, like for property. If they're
Yeah.
not, they exhausted outside of super,
Yeah.
they can continue with inside of superannuation, and they can build it up quite dramatically. And we've all sort of seen how the property have market have exploded in
Yeah.
Australia. So everyone, is looking for their next opportunity to purchase property.
Yeah.
But there's also things like investing in other alternatives like cryptocurrency, or
Hmm.
investing in gold, or other sort of areas, AI, that the industry superannuation funds are not offering clients. So, from
More
that
conservative.
perspective, exactly, a little more conservative, but
Yeah.
also what the client is more preferred to what they prefer to invest in for themselves. But
Yeah.
yeah, self-managed super fund, great product. Not for everyone, not
Yeah.
for everyone, but it can definitely help meet your financial goals and um, your wealth goals itself.
Yeah. Yeah, no, that's great. There's a lot in there, and I think that's probably one of the best, most comprehensive answers I've had in relation to self-managed super funds, from giving the perspective of both sides too. So thank you for that. Um, Something else that that having sort of older parents and having to sort of navigate, and it's different
Mhm.
age kind of spaces of capital growth versus
Yep.
income in terms of strategies.
Mhm.
How, like, because read more and more about how industry funds are starting to do this whole kind of portfolio balancing, life balancing, I think they're calling it.
Mhm.
But then there's ultimately when people are older and they're no longer working and they need income, how
Mhm.
far ahead do people need to start thinking about switching from, like, and is it simply switching from capital growth versus to, stop reinvesting the dividends kind of thing to investing in the
Mhm.
right things that are going to give them income? How does that kind of balance kind of play out, generally speaking?
Yeah, when look, when I was working for industry, and I used to work for industry superannuation funds, I remember there was a strategy where you sort of um, uh, dial down the risk from for a client from the age of like 55 through to the age of 65. So
Yeah.
they might start the investment from a risk perspective that is sitting in a growth, so which is taking about 70 to 80% risk
Yeah.
in shares and property style assets versus the more defensive space or lower risk options, which is 20 to 30%. So what they do is each year, automatically it's dialed down till they
Mhm.
get to the age of 65. By the time a client would get to the age of 65 and they're ready to retire, we're looking at a more balanced portfolio where 50% of their funds would be invested in shares and taking a little bit more risk. The other 50% would be more invested in defensive assets or low risk options like term deposits, government bonds, and more conservative options like potentially gold as well. It's another sort of product that we've seen, or a commodity that we've seen over the past number of years. Very low risk, but massive returns that we've seen in gold space. But the point
Yeah.
I'm trying to make is that your portfolio, it's all about that asset allocation structure
Yeah.
for when getting into that retiring spaces, to make sure that because you're withdrawing money from these portfolios at 50-50% splits, generally speaking, they can produce returns of about 6 to 7% returns on
Mhm.
investment. And if clients can afford to, withdraw that same 6 to 7% each year from their portfolio to live comfortably, potentially with the help of government incentive for the age pension, then
Mhm.
we're smiling. We're keeping our balance in check. So
Yeah.
you're making 7%, but you're also withdrawing that same 7% each year, which means
Yeah.
that your balance stays sort of flat. It's not
Yeah.
going to grow, but you still have that
That
to
capital
potentially
protection.
pass capital protection to
Yeah.
to to pass down to your loved ones if you're no longer here. Right? But with that said, some people can, if you have a little bit more risk involved or risk tolerance of you, then you
Yeah.
can potentially increase that for your own portfolio,
Yeah.
not sort of highly recommended, because you accessing that money, so you don't necessarily want to access that money if the markets do go down.
Yes. Yeah. I had
Mm.
my parents when they were approaching their, like, from about 75, and well, my mum's still in her 80s and my dad was. It was like 80-20. So I still had, and to be honest, the 20% only was 20% of their portfolio. His portfolio was in shares, was because the capital kept growing. And
Yeah.
I kept on trying to go, oh, we need to like try and balance this. And he still had enough in cash. I was like, I'll just let it keep growing.
Yep.
So
Yep.
it's,
Yep.
yeah, so it just kind of, but I made sure there was plenty of cash there to provide
Hmm.
for like aged care support, whatever was needed.
Yep.
So yeah, so
Yep.
that's another question I get quite a lot, and I'm interested to
Hmm.
hear your perspective on it is when we say investing in shares, like probably 10 plus years ago, everyone's thinking like individual shares, like having to stock pick and, trade, like buying and selling.
Hmm.
Over the last 10 years, more and more has come out that this concept of like ETFs and like industry funds and things.
Yep.
What do you see for people? Like, is there one better than the other, or is it just again depend on what people are after? But like direct share investing versus ETFs.
Yeah, direct share investing, it comes with higher risk involved because we are investing in one company only, as opposed to investing in the entire industry where,
Yeah,
where that one company is operating from.
yeah.
So it's a sort of I'm not going to say it's a no-brainer because other people are sort of they've got different levels of risk tolerances and
Hmm.
they've got their own preferences to companies. So for the large contingent that I've met with my clients, we do a sort of a combination of ETFs or exchange traded funds, as well as managed funds or actively managed investments, where the active managers are trying to outperform the share market. Right? They do invest sort of strategically. You
Yeah,
pay a little bit more for that, but it helps during times when if tariffs come into play again, for example, then the markets tank. Oh, that's what
yeah,
we saw at the start of the year.
yeah.
So these active managers can easily pull those levers in order to respond to the market, as
Hmm.
opposed to an ETF fund. It takes a long time for them to get into or respond to the market than active managers.
Yeah.
So at DreamWise, we like to use a combination of the two.
Hmm.
It's called a satellite approach, where core satellite approach, where the core base of your investment is ETFs,
Yeah.
with some satellites around it or some active managers in the market who are looking at, the interest rates are going down. Oh, let's quickly pull some levers to make some money on the way down or on the way up
Yeah.
for that industry and investments. So I like ETFs because they do capture the market. They
Mhm.
are well diversified depending on which industry or what type of investment you are investing in.
Yeah.
Separately managed accounts, which is SMAs as well. That's
Hmm.
another area that people could be considering for their investments. It's also ETFs, but it's ETFs in in Australian market, international markets, emerging markets, fixed interest, cash. So it has all four or five of those sort of industries all in one,
Hmm.
as opposed to choosing, okay, the top 200 companies as an ETF, and now I need to choose which other industries I need to involve,
Yeah.
as opposed to just getting one separately managed account that
Hmm.
does it all for you.
Right. Okay. Yeah, no, that's a good one. Yeah. I've seen them before. I haven't sort of gone too much down that path, to be honest. But yeah, it's definitely one that needs to probably have a little bit more of a profile for people to understand them. So, and can anybody
Exactly.
access SMAs, or do you have to go through a financial planner to access them?
You have to go through a financial advisor to
Yeah.
access SMEs. Yeah.
Yeah, which again, it's more specialized, and that's what you then pay for that access.
Exactly,
Yeah.
exactly. So that's and with the direct investments, like I said before, it just comes with at a higher price if that company, if anything happens, their directors leave or
Hmm.
people find out about it, they leave with the director, so
Yeah.
that there's a lot more risk involved, and that's why if it's a good company, yes, we want to invest in it as well, but let's not make it our sole focus. Let's make
Yeah.
it part of our strategy.
Yeah, diversify. And strategy is a big
But
thing. I think
yeah,
it's something it's probably lacking for a lot of us in our money because the idea of it just sounds too hard or too scary, and we don't know. But and this sort of leads me a little bit to well, two questions that have sort of the same kind of concept behind it, but trying to find the right financial advisor and someone like yourself who likes to educate and make sure that their clients understand it. So it's about,
Mhm.
you need, like, obviously you're preparing a statement of advice and people are having to understand it enough to sign it, but there's that extra step there about, do you really understand it? So I think that that's a really good measure for when people are
Mhm.
looking for a financial advisor. So
Mhm.
how do you let your clients know that that's an extra sort of added benefit that they get from the service you provide, is that education piece? Like, do you tell them
Yeah.
up front, or how do you make sure that they're because you also want the right clients who want that kind of level of
Yes.
understanding too.
Yeah. So most of my clients they engage me because they want a financial relationship with
Yeah.
with their advisor, not someone that can do a job for them today and then never call them back again. So that's the first step where that's how we that's our service that we do offer. It's an ongoing service with the client. So when we do present the file, it's not like, yeah, there's your statement of advice, there's your financial plan. In See you in later. Yeah.
See you in 12
We
months because I'm
see you in
legally
12 months.
required to see you once a year.
Well, not necessarily, not if they're not signed up for an ongoing service.
Oh,
So
okay.
you
Right.
so you can just present a file and hand that to the client.
Hmm.
Most all my clients I present an ongoing service to as well.
Yeah.
It's only when the client tells me that they only want a self-managed super fund recommendation,
Yeah.
nothing else. That would
Right.
be transactional,
Yeah.
and so we'll leave it there. I'll write the plan for them, and away they go. If they need a lot of cases, they're always coming back.
Yeah.
I would need to set up new costs and all that sort of stuff. So it does help the client and saves money for the client when
Yeah.
they do go ahead with an ongoing service. Now, it does mean that we give you the plan. We also then implement the plan for you.
Yeah.
So with the implementation, it's also an education piece to explain to you what the next steps are.
Hmm.
The next steps are also embedded within the financial plan as well. So you can always refer back to your financial plan to see these are the next steps. Actually, I don't understand step number 4, which is to sell over a portion of your super maybe into a new superannuation platform that can
Hmm.
produce more returns. Why only a small portion? Why not all of it? So then we go back and we explain, well, it's because your existing superannuation fund holds your existing insurance benefits in it.
Yeah.
And if we're going to move all of it out, you won't have insurance anymore. So while we're getting new personal insurances, we have to keep your old ones because anything can happen between those periods where
Yeah.
you don't have anything.
Yeah.
And we've seen that it's happened before. You just don't want your clients to ever be not insured.
Exposed.
So exactly. So a lot of the times I get those sort of questions. Why only a why only a portion? Why are you leaving a small portion in my old account? You have to go back and you have to educate the clients again along the way.
Yeah.
I give them time to ask questions after each strategy that we provide for them,
Yeah.
and then just to explain it back to us as well. Or maybe just like, okay, so what does that mean for you? So, and then you can hear their responses that they've got it or not.
Yeah. And then you can start to get a feel for, okay, do they really understand what I said in the first place? And clearly maybe they didn't.
They
Um,
didn't, yeah.
yeah.
Or maybe it also helps me to understand how deep I need to go with the explanation or not.
Yeah. Well,
And
because money's a journey and there's a language to it. And you might not realize that you haven't understood it until you actually understand part of it. And then you realize that you didn't understand it. So it is an ongoing thing, which is why it's good to have that ongoing sort of support and relationship.
exactly. Because things change in people's lives. So we can give you advice today, but in 2 months' time, you got a promotion from work. All of a
Mm.
sudden, the strategy I gave to you 2 months ago doesn't make it's not relevant. And if advice is not relevant, it's not going to be beneficial to you. So we encourage our clients to always let us know if there's any significant changes along the way, including maybe a loss of job or maybe an accident or a promotion, like I mentioned
Or an
before,
inheritance where
because
you're getting a chunk of money
or
in one go. That's a
or an inheritance. So like, what do I do with all this money now? Like, where do I park it? Well,
mm,
there are ways that we can, and there are products that we can recommend to the client as well
yeah.
when that does happen. So,
Yeah. So I have another
so it
thing
helps
because
to get that ongoing relationship. It's
yeah.
definitely beneficial for the client.
Yeah, it's like having a relationship with a single doctor. They kind of know everything, the history helps them make better diagnoses and decisions. Um,
Exactly.
Something I've been reading about over the years, and yeah, is the concept of robo advice. And everything these days seems to be about using AI, and we're all going to lose our jobs and blah blah blah. Well, I
Mhm.
I I, I'm not a reluctant user of AI. I use it for certain things. Like if I'm going to put captions on a video, I'm going to use AI for that. I'm not going to sit there
Yep,
and
yep,
type
yep.
them out myself. But when it
Fair
comes to
enough.
things that are very human, I don't think artificial intelligence can ever replace human, and not just knowledge, but instinct and connection and all of that. So, how do you see robo advice playing out in the financial advisory industry?
Yeah, look, robo advice, I haven't had a lot of involvement with it, so I can only but imagine it sort of plug in your details and we'll give you a plan. So it's very basic advice. It's still, look, I think it's still a new area, even AI itself, where people
Mm,
are a little bit concerned with giving a platform all the information. I
mm,
believe that when robo advice can help in the sense of there's a platform, it's got all my financial details in there. Maybe ask it, can I save X amount of dollars? And
mhm,
how much can I save if I took out my rent money, for example, out of this platform? And so from that perspective, it can help. I just think that there are some limitations when it comes to the no-buy advice as well. I
yeah,
think that there is a seat at the table to get people to think about speaking to a financial advisor that's going to be more tailored to answering those questions. And nowadays, financial advisors also use AI to help generate. I mean, when we do our calculations and modeling, that's all AI driven, right? It's maybe not on a robo advice scale where we're expecting this AI to give the answers. Do I invest? Do I take out life insurance? Yes, you do. Well, that's if you don't have the cover, it's kind of obvious that you potentially might need it.
yeah,
So, uh, look, there is a space for it. I think it still needs to be a little bit more developed so that people can take or have more confidence in robo advice. We've just at a point where where people are starting to believe more in financial advisors. Now we're asking them to now start believing in robo advice. So it's like, can we just do one thing at a time, sort of,
yeah,
let,
yeah,
let's
yeah,
get the human being, let's sort out, financial
yeah.
advisors first, and then we can deal with things like robo advice. I do, like I said before, it's got a place at a seat at the table, maybe not a full chair,
Yeah.
maybe a kid's
Yeah, just
chair or
a
something, but yeah, but it's
cautionary. Yeah.
it's sort of like like you use Google to search for ideas, use robo advice in the same way.
Yeah. Yeah, because it's interesting when you say we're only just starting to build up because there was a certain lack of credibility that happened in the financial planning industry, and I don't want to use the word victim, but I'm a kind of a product of that because I had an advisor who was just commission based, was very like inhuman in a way, like couldn't answer a lot of questions when I asked for information, just gave me like the standard wrap fund 300 fund like performance report kind of thing, nothing personalized. And I think people that have been burned in that way, the idea of
Yeah.
fee for service feels sometimes more expensive, but at the same time they're like, can I trust this? Like, are they just going to be like the others who are just commission based?
Mhm,
So I
mhm.
think, having advisors like yourself is definitely working to build up the credibility of the industry. So that's great.
Thank you. Yep.
Um, so I wanted to also just tap into a little bit of like money, like as you've given us a lot of really good information about financial planning as a profession and the sort of work and things that they can do. How did money kind of like, how did you, I guess, get interested in even accounting to start with? How did money play out for you when you were growing up? What did you sort of see and what the impressions did you have as a child and teenager?
Yeah, look, as a teenager, I really loved woodwork. I loved doing a little more manual sort of stuff, and it was when I came home one day and I got 100% for one of my projects, and I think that there was either my one of my parents, my dad probably. He's like, look, woodwork is not going to get you the money. It's more like you need to focus on things like IT, programming, and accounting, and that sort of thing. So I was really and truly pushed into accounts by my folks because they wanted obviously the best for myself
Job
growing up in a
security.
job security, all that sort of things. But more importantly, we weren't wealthy at all. We were very average. It was not a great suburb where I grew up. It was back in South Africa. Needless to say, there was a lot of strife and struggle in the 90s, 80s, and so it was a tough time. And look, out of all that, we still managed to help me to sort of pass my or get go through university, do my thing,
Mm,
and then from there it was sort of let's latch onto this accounting. It wasn't always an easy subject for me, accounting, because of the debits and credits and the extra debits and extra credits and yeah, so I've changed over my subjects. I think in year eight, I think, and 2 years before or 3 years before you graduate,
hmm
I changed over from woodwork being my major to accounting.
hmm
And yeah, and also my dad had a lot of influence over my decisions back then.
Yeah.
As a 6 year old, I remember when all the other kids were playing out in the streets, he would have me sit inside from 5 to 6, and we'd go through math book textbooks. So, and I was like, what am I doing? I tried to because I knew this is coming up.
Yeah.
But all of that did help massively in my understanding of mathematics, numbers, sort of problem solving.
Mm,
So, I'll forever be grateful for that. And also, we didn't have a lot of money growing up. So
yeah.
that's why I always wanted to help my parents in a lot of way to get ahead. So that's where the background comes in. That's why I want to sort of teach and help the next person because
Mm,
it's not that hard. It's not difficult. It's
mm,
all habitual that, as humans, we tend to spend more than what we actually earn. That's it's psychology, right? So it's
yeah.
and you know better than me in that space. You do deal with it quite a bit.
Yeah.
But yeah,
We're
it's
very
all the
emotional when it
mindset.
comes to money.
It is an emotional game, and it's partly why I wanted to be in that emotional sort of space because, yeah, it's quite important for people when we do talk about money, we talk about financial goals and, having to achieve it, how we're going to get there. Well, here's your plan there's a roadmap and use this roadmap to reach your financial goals, and I will be there along the way. So
Yeah.
that sort of stuff drives me to take on the next client, to understand their background, and to sort of see myself in those sort of situations if I can. Obviously,
Mm,
not every situation, but from my sort of from my background, not well. There was no wealth. There was just
yeah.
very average, very simple life, dangerous, and then sort of moving on from there, doing my university, and even all the way through, no one taught you about money management. No one did. My parents didn't. They suffered as well as most of South Africa. So yeah, it was just why are they not teaching this in school? Why are they not showing us how best to save? Very simple life skills. It's a life, isn't it a life skill like
It
money
is.
management should be?
Yeah. Should be.
As much as geography is and history, there should be money management
Yeah.
as a core,
Yeah.
just to keep us
Totally agree.
going. And so that was so. If I can bring some of that to the public, then I'm all for it.
Yeah. And have you gone back to woodworking now as a grown up?
No, not yet. This it's building a business. It takes up all your time. Having
Yeah.
kids, it's just like, where's the woodwork in this? Where's
Yeah. Time for
but
you.
but for
Maybe you can
myself,
try
time
and
for
build in
me
some
is
time for it.
I could, but now my hands are quite soft. It's all sort of what do
Or a soft office worker.
soft. I'm a soft office worker, and so now any splint, it's gonna be like, oh no, I can't do that. No, no, no.
Oh, I got a
I'm kidding.
paper cut. No.
Oh, I got a paper cut. Exactly, exactly. But no, look, woodwork was back then when I was obviously in high
Yeah.
school, and I loved it then. And now I'll leave it for the experts and maybe do a project with a professional.
Yeah. Well, you can always join
And
a men's shed.
or that exactly. I've never heard of that, but happy. It
No?
sounds like it's something that I would like to attend. Yep.
You need to check them out. They're
Uh,
all around the city.
yep.
I mean, generally they're for retired men, but that doesn't mean that a younger man can't join. They basically get together and they make stuff. And if there's
Hmm.
like schools or whatever, or organizations in the community that need things, they
Hmm.
help support them by making it. So
Yep.
it could, yeah. But anyway, just a little bit of a,
No,
I'm teasing you slightly, but
no, I know, I know. Thank you.
but no, I'm serious about the men's shed though, because they are. I was trying to get my father to join one, but yeah, and there's also repair cafes out there, but I think men's shed's nice because it's a social thing too.
Yeah.
But yeah,
No,
maybe
it would be
for
nice
down the
to
track.
build, if I could one day build my daughter a sort of tree house or something,
Yeah,
So
perfect.
I don't know. I'm just, yeah,
So,
as business owners, you have all these ideas. Let's do it. Let's do it. Let's do it. And then it's like,
yes, the
when do you
list is
actually,
long.
the list is long. Exactly. When I get there, I will do it for sure.
Yeah. So do you teach your daughter about money?
Well, she's 2 years old, so I
Oh,
teach
two.
her
Oh,
like,
I thought she was older. Okay. Yeah, not yet.
no, not, yeah, not yet, but I teach her to share.
Yes,
Um,
that's a good start. Yeah. But
yep,
yeah, no,
yep, yep.
and it's an important thing as well. I mean, my daughter's 10, so I'm a little bit further down the path there, but it's an interesting one. And I've got teenage my cousin's
Mhm.
children. And
Yep.
I think unless like my daughter's been we've been talking about money since I started her journey on money when she was 5. I was like, okay, we're starting to learn how to count. We can start to talk about
Hmm.
and especially about the value like making versus buying and all of that sort of stuff and now I'm starting to introduce she's 10 I'm starting to introduce the concept of compounding and I really want her to understand that because I think it's probably
Yes.
one of the most powerful concepts when it comes to money and building wealth but when I
Yep.
talk to teenagers they just kind of like gloss over and I have to really make it relevant to things. It's like, well,
Hmm.
buying a car or, buying the thing that you want. Like this is how, and I'm kind of hoping that that thing eventually will become more like a house or an investment
Investment. Yes.
rather than,
Yes.
because
Yes. Yes.
obviously for them retirement's like totally, not interested right now. But yeah, so I'm trying to
Yeah.
find what's the thing that will motivate them to be interested in what I'm talking about. So
Hmm. Hmm.
yeah, but it's
No, that's
definitely we need to have those conversations and that education.
yeah. The earlier the better. If I had those conversations, I might not have had some debt along the way that I needed to have like sacrificed my time to pay off, for example. And I think most people will end up, if not in their mortgage, but at some point have to deal with debt, which
Yeah.
is
Yeah.
quite stressful.
Yes. Yes. I ended up there in my 20s. And sometimes it's just trying to make it not too dramatic so that it doesn't take you too long and pay too much interest
Yep.
to get out of. So yeah. But there's probably a little bit of a, you make mistakes, you learn from them kind of thing. But at the same point, if we can lessen the magnitude of the mistake.
The mistake, exactly,
Yeah.
exactly.
Yeah.
But yeah,
Awesome.
no, I don't teach my daughter. I give my wife some, direction.
Yeah.
When it comes to money and financing and stuff, I build the Excel platform for her to then go in and
Play with.
utilize, if you will, play with,
Yes.
and you know, so
Yeah.
because she's on top of most things in the household, I guess. So,
Yeah.
but yeah, no, she's also. I mean, when it was COVID, she would listen to all my calls about past performance is not a reliable indication of future performances. And we'd have to explain to each client about obviously the drop in the markets, and everyone was calling about that. And so, yeah, so she
Actually in
picked up
May 20
some.
or March
Yes.
2020.
Oh, exactly. March 2020. Oh my goodness. I was
Yeah.
doing five, six
Yeah.
appointments a day
Yes.
with clients. So
But you talked them through
fun
it.
times.
Yeah.
You talk them through it, and you talk yourself as well. You motivate yourself as well in the
Yeah.
same breath, because your money is going doing the same thing as all your
Yeah.
clients. So we're all in this thing together, and that makes it easier to discuss it with my clients as well.
Yeah. And it makes you a more relatable advisor. So no,
Exactly.
that's wonderful. So if people want to find out how to work with you or more about you, how do they do about doing that?
Yeah, so we've got a LinkedIn profile. So I'm on LinkedIn as an individual, and DreamWise Financial Services.
All right.
I've got
We'll
my
put that link.
website, DreamWise as well.
Mhm.
You can go straight to my website and sort of just schedule or let us know about your inquiry, and then we'll get in touch with you and schedule what is called a no obligation
Mhm.
initial meeting,
Yeah.
and it's just to understand the situation and what the client wants to achieve, and then to see whether or not we can actually provide those sort of services and help the client reach that, or respond to their concerns itself.
Yeah.
But that one is no obligation there. Thereafter, we'll then discuss things like the upfront charges, etc.
Yeah. Wonderful. Well, we'll put the links to your website and your LinkedIn profiles in the show notes so people can pursue that a bit more. But thank you so
Perfect,
much.
perfect.
I really appreciate everything that you
No,
shared and your
thank you.
insights.
No, thank you, Alpha. Much appreciated. And thank you for listening, and keep doing what you're doing as well in your space.
Thank
We
you.
need more people like you.
Oh,
So
thanks very much. All right, everybody. Well, I will leave you there to think about everything we just spoke about and have a wonderful week, and I will catch you in the next episode.